Hi, everybody. This is Robert Chadwick with America Mortgages. Thank you again. Thank you always for joining us for our regular webinars. Today we have something special. My co-founder, Donald Clip, will be joining us. We will be talking on this webinar about the strategies that will come into effect if interest rates get reduced. And we do think that interest rates will be reduced in the US as we come closer to the elections. And Donald will also cover what the market trends are for the US as a US real estate investor. So this is our first masterclass. We're pretty excited about it, and we're going to try to continue this as a series as we go. So with that, Donald, thank you for joining today. It's been a while since we've partnered up on a webinar.
Thanks, Robert. It's good to be a part of the action here. It's been a while since we co-hosted one of these events, and I'm really excited to kind of share our findings with the audience. There's been a lot of anecdotes in the news about how unaffordable housing is. It's going to obviously play into a topic in the upcoming elections. But what I want to do is lay the foundation for how we're thinking about the U.S. real estate market, and why structurally we don't see that prices and, more importantly, rental yields can fall. In fact, we're expecting them to increase quite a bit. And there's a structural reason for this, and it's something that can be fixed anytime soon. So I'll go through some of the slides on how we're thinking. We'll showcase some, rental yield comparisons with global cities, and it's going to be really, really interesting. Stay tuned. At the end, there's going to be some Q&A. Ask us about anything, but in particular, if you want to ask us about U.S. real estate and investing, we're here to answer any questions. So stay till the very end. Is this the best time to invest in U.S. real estate? And the answer is yes. And we're going to lay down a systematic approach to explain why we think that is the case. Okay. So in any investment, there's always a reason. It could be, your friend gave you a hot tip. You like to buy Apple because you like the phones. You like Bitcoin and gold because of certain reasons. Whatever it is, we need to apply the same approach to real estate. So with U.S. real estate, we need to go a little bit, not too long, a little bit back to see the sequence of events leading till now, which has created this dislocation in supply and demand, which makes it the investment opportunity that it is now. So, I hope most of you in the audience are old enough to remember the dot-com bubble. That was the late 90s, early 2000s. So the dot-com bubble bursted. There was a global recession, and then there was an unfortunate event, September 11th. But two things happened at the same time, or close to each other. One, China entered the WTO in 2001, so China entered the global marketplace. And two, over the next 2 to 3 years, the Fed lowered interest rates steadily to 1%. So low rates while China entered the global marketplace. We all know what that did to asset prices around the world till now. There was a big push for government home ownership at the time, and home prices in the US rose on average 55% between the years 2000 and 2007. Well, that's a national average. In some places like, LA, in some other markets, Seattle, home prices doubled, tripled as well. So this started to lay the foundation of when things were about to go, as I say, nuclear. Now, that was a bubble. We can kind of, agree. Now, in every bubble, there tends to be three things that are consistent. There's greed, which gives fruit to bad actors. So bad actors are born to take advantage of the greed. And then there's usually a lack of compliance. Now, classic examples recently, FTX, Sam Bankman-Fried, that was a bad actor. He's been, and some other, people in the industry have been taken out of the system. And now Bitcoin, for example, is now something that people feel a little more comfortable with. Now, in the U.S. Real estate, the same thing happened. There was greed, there was over leverage, and there was fraud. But once the bubble burst, new set of, and the last thing is regulations always move slower than greed. Okay, so here's where it gets really interesting. So home prices fell only 8% actually in 2008. You know, a lot of people kind of lost their houses. You know, if you worked at Bear Stearns and Lehman Brothers, obviously that wasn't good, but generally speaking, things could have been a lot worse. But what the Fed did at the time was they put the problems on their balance sheet using various tools. Another thing that happened was the government instituted a bank regulation that made it restrictive for bank lending. A typical scenario would be like, listen, we don't want this to happen again, so we're gonna implement this regulation so that doesn't happen. But with interest rates so low, market forces still wanted to buy property, right? So that grew something called wholesale lending. It always existed, but this gave birth to this new growth of wholesale lending, which basically is a bank but doesn't take depositors. Doesn't have savings accounts or checking accounts. And because the role of offering mortgages are in the hands of a private institution, they're just a lot more common sense with how they offer their mortgages. So the fraud is taken out of the system, i.e. bad actors. Interest rates are still low. And this is where this asset price inflation really starts to take off. And this is where you'll read things like debasement of currency and those type of things. And in a debasement of currency world, you want to own scarce assets. What are scarce assets? Well, that's gold, real estate, and Bitcoin, right? Or crypto. And you see these things kind of playing out at the moment. But why is real estate scarce? I mean, you can just build whenever you want, but that's actually not the case. There's a massive dislocation in supply of US homes in the US. Now, why is that? Okay, so, unlike Singapore, where housing is subsidized by the government, harmony, in the US, the major home builders are listed companies. They have, CEOs that fly around in private jets, and they get paid and compensated by how their share price performs. So imagine you're this listed company, the world exploded, housing prices collapsed. The last thing you're going to do is go to your board and say, hey, listen, I want to build 1,000 homes. So that took a little while to kind of play catch up, right? But with low rates, China coming into the market, demand was really high, and a lot of smart people came in and bought homes at low levels, and share prices rebounded. Not share price, home prices, sorry. Now, so since then, till now, home builders are still playing catch up, right? So there's an incredible severe housing shortage in the US. So this is factual information from 2012 to 2022, last 10 years, more or less. 6.5 million households were formed, and this is according to the Census Bureau, were formed versus homes built. 6.5 million more homes were created versus homes built. There's a current 5.5 million home shortage just to meet demand. Okay, now there's all sorts of things that play into account. There's labor costs, raw material costs. It's really difficult to get zoning, done in the US so home builders can actually buy. And that's just caused this really, really tight supply. And we think, and of course, we all want to fix this problem, but we think that this problem isn't going to get fixed anytime soon, which creates an unfortunate opportunity for renters, but an incredible opportunity for investors. So more on supply. So there's two types of supply. There's new homes being built, and there's existing homes. So we'll start with existing homes. So of all the existing homes in the US, 80% of the ones with a mortgage have their mortgage rates fixed for 30 years under 5%. 40% of all mortgages are fixed for 30 years under 3%. So what that means is that up to 80% of all mortgages in the US, they're not selling their homes, because if they want to buy a new home, the rates are going to be higher. And if they sell their home, they'll have to pay capital gains, or they'll have to buy a more expensive home using the 1031 exchange and pushing out your capital gains. In a nutshell, those existing homes, it's stuck. It's kind of, they're squeezed. Nobody's moving. And then the new homes, as I said earlier, there's a big shortage because home builders aren't building. So who else knows this? Is if you Google institutional buying of single-family homes, you'll see a laundry list of articles that seem to not really make it to mass media, which is institutions like Blackstone and BlackRock, which we can argue are fairly good at what they do. And the classic Blackstone real estate playbook, and they've said this, is that they identify supply-demand imbalances like single-family homes. They invest billions to create ginormous landlords, charge fees, dictate rent. So you can Google, all the information is there. So we think, isn't it smart to invest alongside these institutions? Because they seem to have a pretty good track record of getting it right. You've got this happening in the background. So now we go to demand. Okay. So work from home was already happening. 10, 20, 30, 50 years from now, none of us are going to be going to the office, right? So work from home was growing at 2.5 to 5% per annum. Now, what COVID did is that went to 100% overnight. And it's hard to kind of scale back that once you've reached 100%. Work habits are not going to reverse. Now, of course, companies want you to go back to the office, and that is happening at the moment. So that's one. So there's a big demand to kind of find a place that's maybe close to driving distance from your office that you can rent and live. One of the most underappreciated aspects to the US is the ease at which it gentrifies state to state. If you can't afford to live in California, you can rent a U-Haul, drive to Texas, start a new life, get a job, kids go to public school, and you make it work. And these tend to be, states with lower cost of living, lower estate taxes. And that's what's kind of happening now. If you think about all the cool and exciting companies that we hear about, whether that's Tesla, Nvidia, Facebook, you name it, Amazon, they were all created on the coastal states. And once those companies get really big and hire tens of thousands of people, nobody can afford to live in those states, and they all kind of migrate to places like Texas, Florida, Georgia, which we'll talk about in a bit, because those are just cheaper to live. And there's no surprise that Dallas, Texas, is the headquarters of the most Fortune 500 companies in the world. I mean, Tesla just moved there, I think 2 or 3 years ago. It's the who's there, right? So another thing that, through our research we found is that there is a new movement to earn side income, side hustles, the gig economy, whether that's drop shipping on Amazon or doing stuff on TikTok or whatever it is. But now when a small couple or two roommates say, let's rent a place for, 1,000 square feet, they say, well, let's add 200 more square feet so we can set up lighting and a camera and that additional square foot demand is really causing this increase in demand. All these factors are causing this massive increase in demand, especially in these lower cost of living states. At the same time, that supply is severely constricted. So we all know what happens when demand outstrips supply, right? Prices go up. Okay, so here's where it gets super interesting. So this is, a snapshot of kind of where people live in the world. Now, if you look at the G7, it's kind of known as G20 now, but say the biggest countries in the world, you look at the rental yields, not really that exciting, 4%, Japan, really popular right now, but the rental yields are very meager. You look at the Asian nations, including Australia, also barely above 4%. Indonesia is 4.5%, but they have to deal with currency issues. You look at Vietnam and Philippines, these are the two hottest real estate markets in the world over the past few years. Just because price appreciation goes up doesn't mean that rental yields go up. In fact, quite the opposite, because there is a theoretical cap on how much you can charge somebody for rent in countries. UAE is a unique situation. It offers low inventory. A lot of people are trying to move there because of ease of immigration, low taxes. A lot of emerging countries are moving there. So it ticks all the boxes. You get rental yield and price appreciation. That market hasn't been around a long time. The US, on average, 8%, mind-boggling, ranked 12th in the world. Between 1 and 12 are not insignificant, but smaller countries in Latin America that nobody really buys property to invest in anyway. The point is 8% US dollar growth market, supply shortage, massive demand. I'll take that any day. Right, so that was kind of surprising when our research team unveiled the results of that work that they did. Here's where it gets super interesting. look at the rental yields of these cities. Detroit, 32%. Now, these are city center rental yields. So this is a real shock. When people see this, they can't believe it, but it's public information. Just go on Zillow and you can find all this information. Now, all of these cities represent something different. There could be, Detroit is kind of in more industrial. Some of these are college towns. Miami, obviously, is just a lot of people moving there because it's a, kind of a cool place to live. Atlanta is a place that I really like, which I'll talk about in a little while. And all of these cities have different price points. Obviously, Miami is a higher price point, and maybe, I don't know factually, but let's just say New Orleans might be lower, right? Ann Arbor, obviously, that's a college town. Las Vegas, a lot of expo traffic is going there. So in the US, it's something for everybody. You've got trophy assets in Miami, Beverly Hills, and Park Avenue in New York. You've got affordable investment starter homes that you can buy and earn rental income. And there's also different strategies. The Bur Method, which I'm going to talk about, student housing. You can bet on this new trend in, EV factories being built in the Southeast corridor. So which I'm going to talk about in a moment. Okay, so the Bur Method. So this has been popular, recently, and the numbers here are an actual client of ours who used our loans to achieve these economic outcomes. And in fact, in 3 short years, they own 15 homes, quit their job, and traveling the US and living the dream. And we help them to achieve that dream. So I'll give you an example. So in 2000, I'm sort of gonna speed this up a little bit so you don't get inundated with the numbers, but basically 2021 to 2023, they bought 3 homes, 85, 182, and $125,000, right? And the cumulative rent for these 3 units is about $4,300. Okay, so the Bur Method is you buy them, you can use various ways, you can use our loans, you can use a bridging loan, but the key is to find a somewhat mispriced home in an area with transparent pricing. So if all the homes are 200,000 and this one's 100, 125,000, you're like, huh, that's interesting. So what you go in, you get your contractor and your on the ground team, and you say, hey, listen, if we put 20,000 into this, could we reappraise it up? And which is what they did. They put a little bit of money, 20 to 30,000 max in these properties. Just 2 months ago, these were all appraised. So the cumulative purchase price, $390,000. It reappraised 2 years, actually less than 2 years, at $570,000. Okay, so you can see the average increases there. So what they did then was they used our loans to refinance 60% of the 569,000 for 341,000. Okay, so which means that 390 minus 340 is $50,000, which means their net outflow is $50,000, and they're earning $4,300 in rent a month. So that's gross. So you take off half for mortgage, tax, and all that kind of stuff. You're still at, $2,500, which means if you annualize this, you make your money back in 2 years, and then it's all upside, right? So this is how you use debt to your advantage. I mean, there's a famous book called Rich Dad, Poor Dad, and he talks about smart debt. Because in the US, the system allows you to use debt. It's not taxed. There's a lot of benefits. So this is the Bur Method. It's super popular, and we have a lot of information on this, on how to achieve this when you're ready. So the next one is student housing. So friends at Blackstone are kind of onto this idea. But if you think about it, over the past 20, 30 years, how many four-year universities have been built? There's no new universities being built. There's been additional, facilities being built, but student housing isn't being built like the facilities. So you have China, a lot of these countries over the last 20 years, a lot more applicants have, in fact, 15 times more applicants over the past, since 2000 till now, applying to US four-year universities, but supply of these universities and housing hasn't moved. So a lot of demand, supply hasn't changed, student housing has to go somewhere, the schools don't have enough, so they have to find off-campus housing. So our friends at Blackstone are onto this. They just, 2022, they spent $13 billion to purchase off-campus community near Austin. And these are dorms, no rooms, bed, And these things are going for $1,300 a month, right? So the top college towns that we think are good for these are here listed: Austin, Ann Arbor, Provo. I'm not going to go through all of them. You can have the slide later. But again, Blackstone's real estate playbook. You find out where there's supply-demand problems, you own as many as you can, and you ride the trend. Now, this is a little more old-fashioned investing. I really like Atlanta. Atlanta is the busiest airport in the world. Many people don't know that, but it's geographically, situated in an area of the United States where it's just easy to get around. It's a beautiful city, but it's benefiting from three things that, aside from low cost of living and people moving there for the reasons I mentioned in the previous slides. One, USA Soccer is moving to Atlanta. So when they host the World Cup, can't remember, I think 2026 maybe, the US, it's going to add to all the excitement for, obviously Messi has put us on the map, the US on the map, but that's a big event. The second is, it's the Hollywood of the South. You'd be shocked at how many Hollywood movies are being produced in Atlanta. They have tax incentive for movies being produced there. It's a low cost, good transportation. People can fly back to their, fancy places in New York and, Beverly Hills very easily. And last but not least, 9 EV factories are being built in the Southeast corridor. So that's the Georgia, Louisiana, Tennessee, the Carolinas. And each one of these EV plants hire thousands and thousands of people. And when I look at it, these are thousands and thousands of potential renters, right? So Atlanta gives a good combination of capital appreciation plus rental yield, plus you've got these macro drivers of people potentially, moving there for Airbnbs and, living there and moving there from the other cities. So that's Atlanta. All right. So this is almost the most popular question that we get asked, is like, should I buy now, right? And I always say the same thing. If you can make the numbers work now, they're only going to get better. Here's an example for illustrative purposes. So say you see a house that you like, it's $500,000. You come to us for a mortgage. We give you 75% loan to value, even as a foreign national living overseas. So, the loan is for $375,000. You put down $125,000, and this is just an example. It's fixed for 30 years at 8%. So your mortgage payments are $2,500. It rents for $4,000. So you're making gross $1,500. You knock off half of that, $800 and some change times 12. It's a decent cash flow. All right. So the numbers work in 2024. In 2026, let's just assume that home increases 5% per annum. And we all know that actually it's going to go up more than that, because of all the reasons I just said in the previous slides. 5% per annum is the historical average. Okay. So that home now is $550,000. Now what you do is you refinance that new price of $550,000, 75% loan to value. So you refinance $412,000, but the rate now is 6% for 30 years. So we assume that rates fall over the next 2 years. So now your mortgage payment is $1,800, and rents are going up for the reasons I just mentioned previously. And for argument's sake, let's say they go up 10% per annum. So now it's renting for $4,800. Okay. So now your gross rental income is $3,000. Now that's the game that we're playing. So, you can wait for the interest rates, but, if you can make it work, you should pull the trigger, because prices are not staying where they are. Right. For me, for my slides, I think the next portion, Robert will talk about the mortgages, different strategies, how to qualify, all that stuff. And then at the end, we'll just open it up for anything you want to ask us, specifically with real estate or other things. And look forward to hearing all of your questions.
Thank you, Donald. Super, super insightful. I know you spent a lot of time doing this research along with our team. So, thanks to everybody involved. Just to kind of touch on a few things that you talked about. When do you think U.S. interest rates will go down, especially as we near the elections? And what do you think rates will come down to?
Yeah, I mean, there's a should they be lowered and will they be lowered? Like, the U.S. economy is gangbusters. A lot of that was, COVID rebound, but it is accelerating. But there's an election coming, and there's all sorts of things happening behind the scenes that, that are in play. Do I think they're going to cut? I do. I think they'll cut no more than 2 times the second half of this year, or maybe it's just one. It's quite well telegraphed by Jerome Powell. But you get the benefits of, the underlying issue is that people are unhappy because they can't afford anything. If you're a wage earner, you can't afford your rent and you're kind of forced to rent. But you have to put on a different lens to say, actually, that means it's a good time. That means you can't buy, the average person can't buy, he has to rent, and landlords will have the pricing power in this new kind of world.
Yeah, I think you're spot on, and I find our more sophisticated investors tend to be buying now because they do realize that when interest rates go down, people are going to start rushing back into the market, especially the owner-occupied borrowers that have just been sitting on the sideline, like you mentioned, guys that were sitting on sub 4% rates. As soon as rates go down, you're going to have this frenzy again, and I think it's going to be something similar to COVID. So if the investors buy now, they're going to almost get instant equity as soon as the market turns. So with that, I will start my slides. We'll talk about the various loan options that are available for foreign nationals and expats, and after we will do a question and answer session. So you can drop your questions into the chat and we'll address them towards the end. Also keep in mind there is a link in the chat that will allow you to book an appointment with one of our loan officers. We have loan officers all around the world, speak a variety of languages, so the calendar is open 24/7 at your convenience. So U.S. mortgage loans for international clients. As a company, our only focus is providing U.S. mortgages for foreign nationals and expat. 100% of our clients fit this criteria. There truly is nobody that does this better. All of our loan programs, no U.S. credit is required. We prefer if you have credit from your home country. It makes things a lot easier. But in the event, in certain countries, such as, well, UAE now has a credit reporting agency, but prior, we would have alternative means for that. No AUM required. And what exactly does that mean? We do not require you to fund a U.S. bank account with a certain amount of money that needs to be held in that account for that term of the loan, which one of the major banks that also does international mortgages is a requirement. So you can use your money at will without any requirement for this. Foreign income is allowed, whether you're a U.S. expat or a foreign national. We have loan programs in all 50 states. So regardless of where you choose to invest, we will be able to assist. If you're a foreign national, we can get up to 75% financing on a purchase. And if it's a refinance, we can get up to 70%. So pulling cash out, you can get up to 70%. If you're a U.S. expat, we try to make it exactly as if you're walking into a U.S. bank, living and working in the U.S. No W-2 is required, same market rates as you would be able to get if you were to go to the big bracket banks, but actually they cannot help you. Normally, once you submit all your documents, we can issue a loan approval in 72 hours. This is a great way if you're looking for a property to obtain a pre-approval letter. So you have this, when you find that perfect property, you do not have to wait. You can submit it with your offer. The average U.S. closing time is 30 to 45 days, and you do not have to travel to the U.S. There's at least 4 different ways that we can sign your closing documents in the country that you're living in. We offer purchases, refinances, and equity or cash releases. 30-year amortization regardless of age. Super unique for the US. I think it's probably the only place in the world that you cannot discriminate against age. So the US feels if you're 19 or 99, you should still have the same benefits and opportunities. So you can still get a 30-year, or even we have a 40-year mortgage, even if you're 99 years old. 10-year interest servicing only loan. This is absolutely fantastic. What this does, especially now where rates are a bit higher, you can fix your rate for a 10-year period, paying only the interest portion. After that 10-year period, you would expect that rate to readjust to the current rates at that time. that rate stays fixed at that amount. All it does is turn into a 30-year amortized principal and interest loan. So you have a total 40-year tenure, but you also have 40 years of surety of knowing what that mortgage payment is. And what Donald had explained in the previous slide about rents going up, think of the passive income opportunities you're going to have if you hold these properties for a long period of time. We have loan programs that are common sense underwriting. What does that mean? Well, if you're going to buy a commercial property, such as a building, you're not going to qualify off of your personal rental income or your personal income earned. What you would qualify on is the cash flow of the property. That's how we qualify the rental properties. It absolutely makes sense. If the rental income qualifies on the property, the loan qualifies. And I'll go into that in another slide. We are very proud that 97% of our loans actually get approved. If for some reason it doesn't get approved, it's normally because of the property and not the borrower. And as we mentioned earlier, our calendars are open 24 hours a day, 7 days a week, with 30 loan officers working in 12 different countries, speaking a variety of language, working in your time zone. No longer do you have to be up at 3 in the morning to talk to a loan officer in New York and explain why Hong Kong doesn't have a zip code. That no longer exists. You can work at your convenience. So here are our loan programs. This is our most popular loan. This is what I was talking about earlier. This is just pure common sense underwriting. No personal income is required. What you're going to qualify on is the rental income. And how that is determined is when we do an appraisal for the property, we also do a supplement for the rent. And just like they would do comparisons of the property value, they do comparisons of the property rent. That is the income that you qualify on, and it's normally a one-for-one basis. We have loan amounts as low as $150,000, and with an LTV as high as 75%, you're only looking at a $200,000 purchase. Basically, this means almost anybody can be a real estate investor in the US. 30-year fixed, interest only, programs available, and the average closing time is 30 to 45 days. Now, how this loan program works is if you take the gross expected rental income, and in this example, we use $2,400, the total mortgage payment, which includes the principal, the interest, the tax, and insurance, is $2,400. The loan qualifies. We actually even have a loan program that dips a little bit below that, but there is a premium in the rate, but it allows you to qualify even if the rental income only meets up to 75%. If you have questions on this, we can cover it at a later date, or you can make an appointment to speak with one of the loan officers. Our Investor Plus mortgages, this uses income and actually has a little bit better pricing, but there's no tax returns required. I mean, can you imagine we're doing loans all around the world? If our underwriting had to go through tax returns, from a variety of countries, it would just be a nightmare. So how we do it is we qualify the borrower using an income letter. If they're employed, it's from their employer. If they're self-employed, it's from their accountant. And that merely states 2 years of income and current year to date. We have a very easy template that your either employer or accountant can follow. And it's a very simple, easy way to verify income. Again, no US credit or residency is required. Loan amounts $150,000. 30-year fix, 75% financing, and a quick 30 to 45-day closing. How this works is we need to be at a debt-to-income ratio of 43% or less. So in this example, we use $10,000 in income. As long as the mortgage payments, principal, taxes, insurance, $4,300 or below, the loan qualifies. And again, on any of these programs, if for some reason it doesn't meet the debt to income ratio, or you don't have enough rent to cover the property, it doesn't mean that the loan doesn't qualify. It just means maybe you won't be able to get the maximum loan to value. So our US expat mortgage, very popular. We do a lot of expat loans. We tend to see a lot of loans where somebody would go to one of the big US banks and they go halfway through the process. And then the underwriter says, oh, wait a minute, you're earning, your income in euros, and, we can't accept that. So we see a lot of fallouts from this. For us, foreign earned income is absolutely allowed. We need 2 years of tax returns, just as you would file in the US. You do not need a W-2, which is a huge thing if you're a US expat. You qualify the same as if you were living and working in the US. We do require right now that you have a minimum credit score of 680, but that seems to be fairly obtainable these days, so it shouldn't be too much of a hurdle. Again, loan amounts from $150,000, and in this case, all the way up to $5 million. How, again, it works is we need that debt-to-income ratio below 43%. So again, in this example, $10,000. Total mortgage payments, so principal, tax, and interest is $4,300. The loan will qualify. So this is a very interesting loan. We work with a lot of private banks. As you know, wealthy people have very complicated tax returns, multiple jurisdictions, multiple agencies, whatever it may be. We've tried with like all of our loan programs to simplify this as much as possible. So for our high net worth program, we do not want your personal income. So we don't want your tax returns. We don't want your pay stubs. What we're going to do is qualify you on a 2-month average of your liquid portfolio. That's cash, bonds, stocks, crypto, etc. There's no AUM required, meaning that you do not need to pledge this portfolio. And we can do these loans from $3 million as high as $100 million. The LTV is probably around 60%. Sometimes we can push it a little bit more. But the fantastic thing about this loan program is you're using these assets to qualify, but there's absolutely no encumbrance on these assets. Meaning the day after this loan closes, you can trade it, you can sell it, you can do whatever you want, but the loan qualified using it. Fantastic program. How this works is what we do is we take a 2-month average of the portfolio. Say in this example, you have $5 million. We divide it over a fixed period of the loan. This certainly could probably go over 30 years, but in this particular case, the client only wanted a 5-year fixed, amortized over 30. So we take 60 months, it averages to $83,000 approximately a month, and we use that as your mortgage payment. So in this case, it's $80,000 mortgage payment, loan qualifies. This, again, super popular program. A lot of our clients have children that are attending school abroad in the US. Often after the first year, they want to buy a property for their child to live in. And there's a variety of reasons. And there's actually even a way for them to build US credit, which, is paramount if your kids intend to live in the US after graduating. The great part of this loan program and what makes this super unique to American Mortgage is you do not have to use your personal income to qualify. A lot of times on these, when you're buying a property for your student, it would be treated as a second home, meaning that you would have to carry your local housing debt along with the new housing debt in the US, and often it doesn't work. In this case, we do it just as we would do the rental coverage loan. We'll get an estimation of what the rent will be. We'll use that as the income to qualify, even though your child will be the renter, but that's how the loan qualifies. Super easy, again, as low as $150,000 all the way up to $3 million. The example of that is exactly as we saw in the rental coverage. So as long as the gross rent can cover the mortgage, the loan will qualify. So that is it for my presentation. If you scan the QR code on there, you can get all of our contact information and information on loan programs. I'll open this up now to our question and answer. Looks like we already have quite a bit, Donald. So what I'll do, Donald, is let me read the questions, and then pertains to you, jump in, pertains to me on the mortgage side, I'll jump in, and then we can kind of exchange some ideas on it. First question, should I wait until interest rates get lower or buy now? Donald, you want to?
Yeah, so that was one of the slides. Should I buy now? You should not wait, because rates may or may not fall. We think they will, but we can almost be assured, and we went through the argument, that prices are going up, right? So even if, rates quadrupled in the last 2 years and property prices still went up across the board in the US, imagine what happens when rates actually do go down, right? So what is that saying you like to say, Robert? You date
Oh,
the.
you marry the property and you date the rate.
That's right.
Yeah, I mean, it's very appropriate, especially
Yeah.
now. And I think if you look at what are really our investors that have a lot of portfolios, this is where they're jumping in. This is where they're buying because they know as soon as interest rates do go down, there's going to be a frenzy. You can always refinance the property, but you're not always going to be able to get the best purchase price. Okay, next question. Donald, you can take this one again. In your
Yep.
opinion, which areas are great for buying now?
Yeah, so the answer to that is you have to kind of look in the mirror and do your own homework and say, what are you buying the property for, right? It's just like any investment. If you're looking for a place to have so you can, go visit your child when they're in university and using our AM Student Plus mortgages, that's a different kind of rationale. If you're looking for just, I want to buy a place and hope it goes up, well, Detroit has 30-some% rental yields, right? I personally like Atlanta. That's also not a I'm not saying that that's where you should buy. You should do your own homework. It really depends on what you're looking for. I personally think the southern states are good. Texas, Georgia are kind of interesting to me just because they're just cheaper, you know.
I agree. I think if you look especially at the global markets, look at Canada, for example, look at how the prices have skyrocketed almost to a point to where you really can no longer be a real estate investor, at least without having a big checkbook anyway. So next question, any risk of waiting for rates to drop? I'll jump in here and then Donald, you can kind of add to it. But I think the biggest risk is and we saw this during COVID when rates were super inexpensive. The people were bidding 5, 10, 15, 20%, even higher over properties just from this fear of missing out. I think when interest rates drop, we're going to see this again. Again, everybody kind of waiting on the sidelines. So I think the risk is paying more for a property. Certainly, marry the property, date the rate. You can always refinance, but you're not always going to be able to get the best rate. Donald, do you have any?
Yeah, no, totally agree. I mean, well said.
Yeah.
It's if you do the numbers, your net cash expense is more sensitive to the property price than the actual interest rate. By the time you wait for the interest rate to fall to where you want it to, the property price is going to be 20% higher, and that's what you risk.
And I think too, if you look at our journey with our clients, it's not a one-time transaction. We will, if rates drop, dramatically, we will let you know when is a good time to refinance, and we'll work out the numbers for you to see when the break even is on, the cost to refinance. Next question: are there age restrictions for retirees applying for a mortgage? And I had covered this in one of the slides, and I think a couple times. The U.S. is very, very unique. Besides the fact that we have very long fixed tenure opportunities, there are no age restrictions. So again, I'm not sure what age you are retired at, but as you can go as high as you want. Hopefully, you're living to 100, still investing in real estate. Next question. What are the 4 different ways of closing on a property? Speaking as an expat in Hong Kong. So it really depends on the state, the title company, etc. But on average, you can go to the U.S. Embassy, which is obviously the easiest. It's not that easy to get appointments. So that can be a little bit challenging, but certainly available. There's something called a RON, which is a remote online notary, meaning that basically signing on a Zoom. That's a little bit more iffy. Not all states allow that still. You can do a power of attorney if that is allowed, meaning that you could have a trusted advisor sign on your behalf in the US. And the most simple way is you fly to the US. You fly to the US and sign. And there's actually even a little bit of tax advantages to that because if you're using it in, buying properties as an investment, there often can be the deduction of the trip. Okay, next question. Does being an expat without a W-2 affect mortgage rates and terms? Fantastic question. We get that all the time. Absolutely not. We do not require a W-2 as a US expat. Again, we try to make it look like you living and working in the US and just walking into the bank. Next question. What is the maximum LTV for foreign investors? Is it income dependent? So the maximum loan to value is 75%, and it is not income dependent if you qualify on the rental income of the property, which is probably the most common mortgage option or mortgage program that we have. Next question. If I want to buy a property for my daughter attending school in the US, how would I qualify? My personal income question. This goes actually to the question that we had earlier. Most of the student loans that we do, the borrowers choose to qualify on the potential rental income of the property. Now, I realize obviously your child is staying there, but this is still used. And I think the reason behind this, I know the underwriting reason behind this is normally you're not buying a one-bedroom apartment. You're buying something that can be shared and can be rented out as well. Next question. Are you able to connect foreign investors with local realtors and a support network, i.e. contractors, property managers, insurance, to invest in the US market from a distance? Donald, you want to?
Yeah, for the people that, kind of are knowledgeable about the US, they have their own, means, but sort of new investors need a little more, hand-holding and more education. This is where we come in. So we have all the pieces to the puzzle. We have accountants that can help you set up LLCs, give you tax advice. We have a realtor network in all the major cities that we trust and we use that we can refer you to. And we also have, and this is really the key, a trusted property manager that operates in most states in the US. And they're actually quite reasonable. So we have all the all the people that you need to develop your on-the-ground team. We have those relationships, and we're happy to share those with you.
So we have there's a portion on our website at americamortgages.com. It's the concierge section, and as Donald mentioned, it's everything from connecting to a realtor to if you need proper FX transferring funds when you're buying, everything that you would need in order to be able to successfully transact a U.S. real estate transaction. What is the average mortgage rate for foreign buyers of U.S. properties at 75% loan to value through America Mortgages? This is a really good question. It's normally approximately 1% higher than what a U.S. citizen would pay. So right now, if you're looking at a U.S. citizen with excellent credit, buying an investment property, they're going to be in the 7s. As a foreign national, you're going to be in the 8% range. Now, again, we do expect these rates to come down, but when you factor in programs such as a 10-year fixed interest only, it really brings the interest rate down, especially as the property values go up. Not the interest rate, the mortgage payments down. Next question. Does the Rental Coverage Plus program require tax returns? It does not. What makes this program super simple and very easy to qualify for is it qualifies only on the rental income of the property, which, if you think about when you're buying an investment property, is actually the proper way that you should qualify an investment property. So the answer to your question is no. Next question, do you provide loans to renovate and flip properties? It's a question we get often, and it's a very good question. Yes and no. Yes, we provide, but it's very difficult for a foreigner to qualify unless they have extensive experience. So I think they need to have done this, I believe 5 times in order to qualify for a fix and flip. So there's not a lot of investors, maybe the Canadian or the Mexican investors may have that option, but in general, it's very difficult to obtain those loans. Next question, how does some recent changes in the commission laws impact the whole process? I'll answer this, and Donald, if you have anything you want to add, but the commission laws have really just impacted the realtors. It doesn't impact the mortgage lenders at all. And I believe it's state specific. I know in California, it's caused quite an uproar. But when it comes to obtaining financing, it won't affect your mortgage or the loan programs that we offer. I don't know, Donald, if you have anything you
No,
want to add.
that's good. There's one on the bottom. Do you have any thoughts on investing in Durham, North Carolina, in terms of rental yield? Again, anything I say does not constitute as a reason to be buying in these places. So I just wanted to get it out there. But the thinking is sound, right? So that North Carolina, the Carolinas, that's part of that southeast corridor. In fact, basically, the top cities in North Carolina, 40% are renters, because it's a market where people want to live. It's a good quality of life. It's a higher standard of living, but nobody can afford to buy, so they have to rent. And in fact, Durham gets the flow down from Charlotte and Raleigh. So those places, it's kind of like you can't afford to live in San Francisco and Los Angeles, so you kind of move down to San Diego, which is also expensive. So Durham is interesting. There's a big population growth into Durham because people just can't afford to live in the bigger cities. So yeah, it's interesting. I think the rental yields, if I had to guess, probably 15. It's just a guess. But there's information is readily available. So if you Google rental yield, Durham, North Carolina, I'm sure it'll just pop out.
And we're actually coming up with I guess a report. Soon you can download it from our website or from our weekly mailers if you're receiving them. And it's going to cover all 50 states and our opinions on the variety of the various states where rental yields are and why we think it's a good state to invest in. The minimum loan amount is $150,000. Can it be lower? Yes and no. In special occasions, we can get maybe an exception to go as low as 100,000. But if you own multiple properties, we can group the properties together to be able to meet, the minimum loan amount on a portfolio loan. So that's something we can look at. I would highly recommend making an appointment with one of our loan officers. And again, the link for that is in the chat. So you can go and book a meeting, again, 24/7. And I think, besides the questions that came up, there's probably a lot more questions. Getting pre-approved for a loan, absolutely free. So if you are considering buying a property, the most important thing is to get pre-approved for a mortgage. Get that pre-approval letter. And then once you have that letter, you can go shopping. So it looks like that's all the questions. Donald, I don't know if you have any closing remarks.
No, we act as a financing partner for, your journey into U.S. real estate investing, but use us for information, for a sounding board, for tips. We're aside from the financing, we're trying to educate the people outside the U.S. on how amazing this opportunity is that we've been given, and let's take advantage of it, make some money.
Fantastic. So thank you everybody for attending. Our next webinar, I think, will be in 3 weeks. I'm not exactly sure who it's with yet, but it will be with a very exciting partner. So again, thank you everyone for your time. Good evening, good day, good morning, wherever you may be. All right, thank you.